Okay, so welcome to the show again. In this case, I have the honor of introducing you, Aaron Edelheit. Aaron is the CEO of Mindset Capital, manager of the Mindset Value Fund, and author of The Heartbreak Break, the case for a 24/6 lifestyle. He started out managing a friend's portfolio in 1998 above his parents' garage. He subsequently outperformed 11 years by 800 basis points per year in a former vehicle, just amid the liquidity crisis created by LTCM. And then he stumbled into the tech bubble and it's crashed again. So many things to learn over that period, to say the least. He won that fund in 2011. As he saw an opportunity in single-family rentals. He started buying up these and built a portfolio of 2,500 homes, a portfolio he sold in 2015 to a rate. At that point, Aaron started making some venture capital investments and wrote The Heartbreak. Since last year, he's back with a fund called Mindset Value Fund, and writing a Substack called Mindset Value. I met Aaron thanks to Guy Spire's podcast. I gathered their good friends and I wanted to have the chance to pick his brain myself. And here we are. By the way, Mindset Value Fund was up 22.4% net of fees for the fourth quarter and finished the year up 51.5% net of fees. Welcome to the show, Aaron.
Thank you so much for having me.
Well, it's a pleasure. Okay, so the first question that I want to throw you is, one of your successes came out of the real estate business, selling your prior company for $200 million to a public real estate investment trust after 4 years of insane growth. It didn't come absent pain, I take it, with bright and downsides all along the journey. Can you talk us through that journey and what you learned then, apart from the necessity of giving up the so-called workaholic addiction that you mentioned in your book?
Yeah, so the journey was kind of a roller coaster. So I'm an investor at heart, and I'd never run a business before. And I started on the side just buying foreclosed homes during the foreclosure crisis, fixing them up and renting them out. And I actually started with 16 homes and slowly built it up to like 250 in 2011 and really realized there was this incredible opportunity to go and build a portfolio. And in 2012, we bought 2,000 homes in 1 year, which I don't recommend. And we bought them individually. So we were buying like 13, 15 homes a day. We were making big, it was crazy. And I learned many things and I made many mistakes. One of the biggest learnings that I made was the very large difference between investing and operating. Operating takes a totally different skill set. And the other thing is we had hired all these people with multifamily experience, people educated at the best universities to help manage the portfolio, but they were not used to exponential growth. So having experience and not having like growth experience or explosive growth, there's two different things we had to kind of replace and go through all this management. And I had always thought that, hey, there's this once in a lifetime opportunity. We were buying safe suburban homes, 3-bedroom, 2-bath homes for like $60,000, $65,000. In Nashville, we were paying like $90,000 or $100,000. I thought it was expensive at the time, compared to Atlanta and Charlotte. And we were, fixing them up and renting them out. And I thought, whatever mistakes we make operationally, it will just catch up because these prices won't last. I was right that the prices won't last, but I was wrong at the operational pain and losses that would come from not ramping operations. So we ended 2012 with, we owned 2,000 homes. We had 500 under contract. and we have 500 rented. That's not a recipe for profits. And
Gotcha.
we had to make kind of a hard stop, had to restructure our entire operations, went through a lot of pain and suffering. And finally, it took like 9-12 months to fix everything and get everything right. But we had lost a lot of money, gone through a lot of pain. And at that point, the big boys like Blackstone, Colony Capital came in, and it was just a very different ball game then. So that's, like 2014, we started thinking about selling, talking to people. We sold the company in 2015 because it also turned out that 2,500 was not scale, and that scale really was tens of thousands of homes.
Well, I remember,
yes.
thinking back to that era. I remember the interview that Warren Buffett gave on CNBC saying, I don't know if it was 2009, 2010, but basically he was asked a question, where would you invest right now? And he said, well, if I could do it, I would just buy thousands of homes in the United States, but the caveat being, it's hard to deploy capital into that. And that's a very hard challenge to manage, so I think, I would say the thought was clearly correct. And it looks like, Warren was probably right on that, the whole asset management side of it as well.
Everyone figured it out. So it just took the other part is no one had really managed that many disparate assets before. And there was a lot of, when I told people I was buying homes in 2008, 2009, people looked at me like I had a third eyeball. And then there were a lot, even in 2012, 2013, 2014, there was a lot of disbelief that this could be a business and that it could be managed profitably. And that's been proven correct. Here's the biggest thing that I learned. It has very important implications for investing, is it turns out that the real value for homes is not in the home. It's actually in the land. And so the better opportunity, if I wasn't so blindly focused on just buying as many homes as possible, I experimented on the side buying finished lots, lots of land that you would then put a house on. And that was all finished. It was just ready for a house to go on. And they cost at the time around $40,000, $50,000 to put in all the infrastructure and just get ready for the land. And at the time, you could buy it for $8,000 or $10,000. And so what happens is the homes that we were buying for 65, putting 20,000, 85, they really were worth 150 to 200,000. You had a double, but in the land, you had 3 to 5 times your money with none of the operational intensity. And so in hindsight, I really missed the real opportunity, which is where the value was. And that has profound implications for investors, because investors often look and say, oh, I love this opportunity. Look at how cheap homes were. But for investors, you would have made more money. I would have made more money if I just would have bought Home Depot.
Absolutely.
That's fantastic. That kind of touches on the good point of kind of that you're making that crossover move, right? I mean, you said that you're first and foremost an investor. How is it kind of going from one area to another, and what I think that that insight is very portable. But what else did you learn kind of in that process? That's circling back and kind of impacting your approach to investing now after having been an operator for those years.
One, how hard operations, and you can actually see this where a lot of activists will take over a company, and then you think that everything's going to go great, and then it's like this just big mess, because the difference between investing and operations is very different. The other thing that I learned is how much work is done for show. And this is actually one of the big drivers of why I wrote the book about the hard break, which is the business case for the Sabbath. to basically turn off and not work 1 day a week. In that, lots of people were, I had employees who were like, I had this one manager who was like, I'm working the third shift tonight. And I would, well, third shift, what's that? I don't know what the second shift is. And he was, oh, that's there. I was like, midnight, 1 a.m. I'll be working. And I was like, oh my God, this guy's such a great employee, such a hard worker. And then when we kind of ran into really headlong into why aren't we operationally scaling? Why aren't we working? Why isn't things working? We unraveled, pulled back. He was actually one of our worst and least efficient employees. He was just creating a lot of mess. He was disorganized and he was just creating kind of chaos. And so, one of the reasons that I wrote about the book is I watched all this experience of these hardworking people, some for good reasons, some for bad. And again, some of the lessons I learned, if we had just gone a little bit slower, maybe we could have pivoted more to where the value was. Maybe we could have slowed down growth. The other thing is, instead of 2,500, if I would have bought 1,500 or 2,000 and just let my operations catch up, I would have been more profitable. I might have been able to continue scaling and growing after a little pause. So there's a lot of things that I learned. And then I spent 3.5 years writing the book, just about how this 24/7 always on light is not only bad for profits, bad for business, it's bad for your health, your psychology, et cetera. And so that was really the genesis. One of the main takeaways is how much of the work effort I was seeing was not productive.
Yeah. And Aaron, I have a question regarding you, in this case, now we are talking about the transition, but as it relates to the investments per se, now in this moment or before, prior this break, in your first fund, Sabre, if I'm not wrong, what was your first approach, and the difference between your first approach and your current approach? Because I take it has been an evolution. This is what I take it,
yes.
but I wanna know a little bit.
So when I started the Sabre Value Fund, it was really about small caps, turnarounds, restructuring, insider buying, stocks no one had heard of, and really more towards the smaller side. It was, I had just, I did well, but I made a bunch of mistakes. I started out very young. I started managing money when I was 23. I was literally too young to know that I didn't know anything. But I still did well. And so
yes.
the transition that I have now is, when I started out, there was just a lot less competition. The market was a lot less efficient. And in the US, there were many more companies. The number of companies have actually shrunk. And well, maybe now because of the SPAC boom, you might have an explosion of now public companies. But my evolution now is really learning from my past, learning from my operational experience. And if you think about the evolution of the markets, when I first started in 98, you didn't really have that much computerized trading, algorithmic trading, artificial intelligence. You also have had an explosion of kind of money managers and competition. And so when you think about, like, how can I outperform, or how can I find real value in the market, you really have to find areas where think about how much brain power is focused on making money in the stock market, whether it's computers or humans. People much smarter than me, computer firepower much greater than I have. And how do you do that? And so you kind of have to either find companies that can't be screened well, are misunderstood, or they just don't know exist, or they just aren't focused. So for example, right now, most of my portfolio is outside of the US because the level of competition is just lower. The opportunities are, in my opinion, greater because of that, because of the valuation. And I am looking for reasons why investors do not appreciate something. So I'm looking for a commonly held narrative. A great example that I wrote about in May of last year was Twitter. Completely misunderstood company that was undergoing a transition where the narrative was this was a never do well company that couldn't get out of its way, and they weren't watching the progress of the company plus what an activist had joined the company. Another example is in the emphasis that I'm trying to do is look specifically where there's either a misunderstanding or there's some barrier for why capital and other competition is not looking at it. Another great example is the US cannabis industry. It is federally illegal in the US to have cannabis, to run a cannabis business, but the states allow it. So it creates this weird structure. And because of that, no investment banks and the US stock exchanges will not list these companies. Pension funds, many prime brokers won't let you own US cannabis stocks. And one of the big apps like Robinhood will not let you buy any US cannabis stock that touches the flower for legal liability reasons. And so what's really interesting is cannabis is legal in Canada. Yep. And because it's legal in Canada, Canadian cannabis companies trade on the New York Stock Exchange. But US cannabis companies actually trade in Canada. But they don't even trade on the Toronto Stock Exchange. They trade on exchanges like the Canadian Securities Exchange and the Canadian NEO. And so when you think about all the speculative excess and all the froth and the electric vehicle bubble and the crazy valuations, and we just saw GameStop and all this stuff that's going on, not one Robinhood shareholder owns a company that I own that's on a pro forma basis because they're merging with another company. It's about $2 billion. Owns a company called AYR Strategies. AYR Strategies. Is they can't. You're not allowed. If you prime broker with Pershing and they do the back office for the holding of securities, they don't allow you to own US cannabis stocks. So for me, I love that there's this regulatory barrier that's stopping this massive pool of capital from going to cannabis at the same time that you have because of the elections, the Democrats are very in favor of, at least deregulating or figuring out, cannabis. And there's a sea change in how people view it. In the last November election, 5 states, the voters approved it on a voter referendum. And in most of the US now, it's legal in the state for either medical or recreational. And the last thing that I would say that's very fascinating is that everyone recognizes that COVID was an accelerant to an industry like e-commerce, food delivery, things like that, video games. But the same thing has happened with cannabis. It was deemed an essential service and demand has boomed. Why has demand boomed? People are anxious. People can't sleep at night with insomnia. People are in pain or are depressed. And when you look at the gamut of what you can do to kind of self-treat yourself, you can take hardcore drugs, you can take pharmaceuticals, you can use alcohol, or maybe you can use marijuana, and that's what's been happening. And so demand has been exploding. So you have this huge growth industry. The last thing I'll say that's fascinating about cannabis is it's massive. The illegal industry right now is estimated at like 65 or 70 billion dollars. So it's not like a new industry, right? And the legal industry is now eating the illegal industry. Because if you think about it, you and I would much rather, if we're going to use cannabis, I would like to know that a company's behind it, that I know what's in there, and that I'm buying something that I know what it is, and it's not from the local, drug dealer who I don't even know where he's getting. I may try, trust him, but and so there's this whole sea change going on, and Air Strategies, even today, even after like a kind of a big run, I believe I'm buying it for like 9 or 10 times this year's cash flow and 6 times next year's, for a company growing at like 50 to 100%.
So
it's incredible.
So when you think about the business model there, I mean, one thing that strikes me is, the potential long-term lack of differentiation or margin ability, the ability to kind of preserve margins. I mean, because if you think about it, there isn't, there's a huge market, for corn or for dairy or for any other agricultural product. I mean, these are massive markets. Even beef or poultry. But the margins of these businesses are quite low. Because ultimately they're commodities. And so what I'm wondering is, what would prevent this industry from eventually looking like any other kind of agricultural commodity business, once these kind of regulatory issues become kind of less ominous?
It's a great question, and it's actually one that I wrote about in my newsletter last August, where I called is cannabis the new SaaS? In other words, is it the new software as a service kind of as a stocks, so to speak? And part of the reason, kind of tongue in cheek, I wrote that is that Air Strategies in Massachusetts is achieving approximately 70% gross margins. And once you start talking about gross margins like that, you start saying, wait a minute, that's very close to software margins. Why is that happening? And is it sustainable? And it turns out that on the state and local level, states are rolling out different regulations and different rules. And you have states that are called limited license states. In other words, they're very much restricting who can operate. And on a local level, it's hyper regulated, where you not only need the state approval, you not only need like the county approval, you need the city approval. And some cities say no cannabis in the city. Some cities say you've got to be 500 yards from a school, 300 yards from this, or I probably should use meters. 500 meters from this, okay. 300 meters. I'm just joking. And so you find that where and how you can operate is very, very few places. And some of the places require you to grow it, distribute it to yourself, and sell it. Some places allow you to grow it. And in Massachusetts, for example, you can only own 3 licenses, 3 to have a dispensary, a retail store. And the process to go from a medical to kind of like full adult use has taken Air 2.5 years to get approval. So the regulatory barriers are super high. Why? You can't get high from corn, at least not that I know of.
Grain alcohol,
but what are the margins for alcohol? But that's margins for
No, but Aaron, that's my point though.
But if you look at alcohol and how it rolled out, it took decades for alcohol to be able to cross state lines. It took decades to figure out how it could be sold and who could sell it. And the rules still in place in New Hampshire, for example, if you want to buy alcohol, you can only do it from a state liquor store. So I believe this is very much akin to the 1970s in terms of alcohol distribution laws. And I think it's going to be many, many, many years of these regulatory barriers, and it's going to take a very long time for some of this to get unraveled. That's my thesis. But at the same time, I don't believe, part of my philosophy with the Mindset Value Fund is I'm not just buying all cannabis stocks. Like when I was buying Air last year, this is remarkable, I thought it was trading at 2 or 3 times cash flow. What was my risk? What's my risk if I'm estimating 6 times cash flow in this market, if what you're saying is correct? And which I disagree with, but there is going to be a very profitable business in terms of because of also the medical standards, the testing nature of this. It's brutal what these companies have to go through because of the last 50 or 100 years of scare tactics around what marijuana does to people, which are actually rooted in a lot of racist history when you study it, that it's not actually based on science and medical literature, but it's based on fear and racism around Hispanic and African Americans. And so one of the reasons that I'm really, really bullish on cannabis, by the way, is for the health and wellness side of this. Not to get high, but that's part of the reason why I am bullish on Air specifically and the larger opportunity. But I think you're also right. The last thing I'd say is the future of cannabis is going to be brands. Right now, all of the power is held in these retail and cultivation facilities because a lot of the states have limited license. So it's not like you can get your products in every shelf. And so brands don't matter, but they will matter in the future. And companies like Air are working on brands, and there is opportunities to invest in branded cannabis products now. And I'm doing a lot of work on it.
And Aaron, one thing that I'm just trying to reflect about is you mentioned before that these regulatory problems make the states, the government it doesn't allow the companies to be listed in the market. But do you think this is going to change? And part of the thesis is that this will happen, so you will get a benefit of this enormous amount of possibilities that come with the company listed in the States?
Yes, that's exactly. I had thought before the elections that we were probably 3 or 5 years away. But because of the recent elections, and especially the runoff elections in Georgia, the Democrats now control the presidency, the House, and the Senate. And I now believe we're about 12 or 24 months away from some kind of legislation that gives legal shielding to banks and exchanges. And when that happens, all of these companies will trade on either the NASDAQ or the New York Stock Exchange. And it's my belief that there is a wave of capital ready and willing to invest in this. And I actually believe that it is like a financial crime if you own any of the leading US cannabis companies to sell them, because it's coming faster than many of us had assumed. And I can tell you is that when you talk to the US cannabis companies, they're all scrambling to build out the network that they have, to acquire companies that they want, to move up their schedules, because what's going to happen is the cost of capital is going to plunge for these companies. The available financing and competition will heat up, and the valuations will rise. So for a company like Air, if they want to enter in a couple more states, I expect them to be very active this year, because wherever you invest now, like when I look at like the electric vehicle bubble, by the way, the automotive business is like a terrible business. It's historically like a terrible cyclical business.
But the utility, but the utility business is not, and that's where these companies are going to become transportation utilities.
Well,
and
that hasn't been proved at all. That hasn't been proved at all.
That's the thesis. But look, that's the thesis that you have to be buying into. You have to even be paying, 14 times for GM, let alone 14 times sales for Tesla. Yeah.
But what I'm saying is with cannabis, like in 2022, Air Strategy is going to produce something like $300 million of cash flow. I think they're on their way to producing, in 3 or 5 years, $500 million of cash flow. This is like real cash flow with wonderful 25 to 40% like EBITDA margins. Mm-hmm. Like these are companies that should be trading at very, very strong multiples, where just the legal market, just converting the illegal market to legal is going to, not to mention new people trying it once it's legal and the stigma's off, that the growth is going to be, this is going to be the decade of growth for cannabis. And then I'm paying single digit cash flow multiples for that is absurd.
Absolutely. Mm-hmm. Well, I think this is, we should continue the interview in the second part of this one. That is the masterclass. If you don't mind, we're going to leave it here. And I don't know if in the meanwhile, I should smoke a joint or not. It's like I'm just floating.
only if you're in pain. I'd only recommend that if you're in pain or you're anxious. Hopefully I haven't made you anxious.
Absolutely. I was just joking. Okay. So thanks a lot, Aaron. And we will see you just now again in the second part of the interview. Thanks a lot. And thanks also Aaron. To the audience. Thanks, Michael. And the audience, as always, if you like the video, you like the interview, so please subscribe to the channel and give us a like. And we will be doing all of this all the time we can. So thanks, Aaron. Bye-bye. See ya.
Thank you for having me.